Lesson 1, Part 3, Strategy Formulation. Financial managers will be heavily involved in pulling together the strategy of organisations. Pulling together the strategy then will consider three key areas here. Firstly then they'll need to assess the performance of the organisation by looking at a range of different financial areas within the organisation, such as the level of debt there, the interest costs that are paid. This ensures then that the strategies that have been put in place are working correctly and the company is progressing then towards its objectives. They'll be involved then in the financing decision here. The key measure then around the financing decision is this cost of capital, which we often call the weighted average cost of capital. And we'll look at this in more detail as a recap shortly. Our key objective then in this strategy formulation is to keep that WACC down to minimise it as low as possible, thereby maximising the value of our company. And we'll look at a numerical example of this in due course. Finally, they'll be involved in the strategy formulation of the distribution policy or the dividend policies here. These are crucial then when investors are choosing what companies they want to invest in and where they want to put their money. The policies then will determine the amount then of dividends that are paid out versus the amount of cash that is retained in the business. And investors will make their selection on the company to invest in based on these policies. They'll also be involved then in assessing the corporate performance of our organisations. So really ratios are one of the key measures then that we've probably seen in our studies many times before to measure this corporate performance. We can see then by calculating these ratios the success of our strategies against those corporate objectives. So we'll revisit then a number of kind of key ratios here now and just remind you about them, but there could be others then that perhaps are required when it comes to the exam. So firstly then we're going to look at 6 performance ratios here. And hopefully these are all reasonably familiar to you. Return on capital employed then is the first one. So in order to calculate this one, we need the profit before interest and tax on the top. And we divide that then on the bottom by the equity plus the non-current liabilities. The equity basically plus the debt. Those two factors then are the capital employed. But just a reminder then, another way to get to capital employed is you can take the total assets and deduct the current liabilities. This measure then is really showing how well the company is able to produce profit based on the money that people have invested into it here. Our next measure then is the asset turnover. This then takes revenue on the top line, sales, and again looks at that kind of capital, those assets on the bottom there. So here then we're measuring how well can we generate sales from that capital base there, from that equity and debt, from that capital employed. Now the previous measure we often state as a percentage. Here we would look at this as in terms of time. So is the asset turnover 2 times? So the revenue is twice the equity plus the non-current liabilities. Is it 3 times? Is it 4 times? Then we've got a good old profit margin here. So we've got our gross profit margin, and hopefully we're all very familiar with these. So for the gross profit margin, we've got gross profit there divided by revenue. And again, we would state this as a percentage. We've also got our operating margin. Again, very similar to the gross profit margin. Here, though, we take more deductions. So, all of our relevant costs and expenses come off before we get to the operating profit. Again, both of these will be stated as a percentage. And whilst these are useful, they don't directly show us the growth, the maximisation there of shareholder wealth. Next measure here is very closely looked at by shareholders here. And this again shows us then the profit after tax. So this is generally, the profit available to shareholders divided then by the equity, by the funds then that they've put in the business. So what return then is coming to just the shareholders, because after tax, the interest, the debt holders have already been paid. And again, we would state this as a percentage. Our final measure then is return on equity. So very similar then, really, to the previous ratio here, but we just want to make sure then that on that top line, we've deducted all of the relevant items there. So there might be perhaps some preference dividends that we need to deduct to get to those earnings attributable to ordinary shareholders. We then divide by the shareholders' funds, and shareholders then could compare their percentages here to the prior year, to targets, perhaps to other companies then as well. A further group of ratios then that would be of interest to our shareholders, to our investors, are the investor ratios here. So the first ratio then that we've got is the dividend yield ratio here. So for this one, on the top line, we take the dividend paid per share and we divide them by the ex-div market price per share. Remember, ex-div means after the dividends. Okay, and if you're given a share price here cum div, where a dividend is about to be paid, make sure then that you deduct the forthcoming dividend to get to the ex-div share price. Again, this gives us a nice sensible return on the share price there. What's the percentage that we're getting as a dividend on the share price? Is it 10%, 20% or so on? Earnings per share. This really shows us then how much money the company is generating for each share in the business. So we take then that profit distributable to ordinary shareholders on the top. Normally, we might call that earnings, but we deduct, the interest, we deduct the tax, we deduct the preference dividends. And then on the bottom, we've got the weighted average number of shares. How many shares have we got? And we'll state this measure then normally in a monetary form here. So in, US dollars there. The final ratio I think we've got here then is the price earnings ratio. So this measures then how many times the market price represents the earnings per share. And this is given as a number. So is the market price 10 times the earnings per share? Is it 20? Companies with a high price earnings ratio will generally have very good growth prospects for the future. Another measure then that investors will be very interested in, and the financial manager here is very responsible for, is the weighted average cost of capital. So let's just remind you then how this is put together. So this represents then the average cost of our long-term funds, generally then our equity and debt. Now to work out that average, we need to weight it then according to how the different sources of capital really kind of make up the capital structure of that company. And those proportions then are calculated based on their current market values, because these represent really, the cost and the value of these sources of capital. Ideally then, keeping this measure to a minimum will maximise the value of a company. And it's a key objective for many companies, and we'll actually show you an example of this shortly. So here's a formula then for working out the weighted average cost of capital, and this will be given then on the formula sheet in the exam. And we will spend more time looking at this in specific lessons here around cost of capital. But we need to ensure then that we understand what each of the different components within that formula mean, because in the exam we won't be told what they mean. So KE is the cost of equity. Cost with a K, cost of equity, E is the equity. KD therefore, cost of debt. Okay, other measures then that we'll need to calculate this. We'll also need the market value of the equity. So that's VE, so the number of shares times the share price. We'll need the market value of the debt. So how much debt do we have? What's its market value? And remember then, when we're working out this measure, we'll get tax relief there for the company. Interest is a tax deductible expense, so we need to work out the cost of debt there after tax by doing 1 minus T there. Now, you might use a slightly different version of this formula in your calculations, and watch out for things here like multiple sources of debt there. You might decide, for example, to take each cost on the top line, times it by its associated market value, add those all up, and then on the bottom, divide by the total market value of all of the equity and all of the debt. So let's look at an example here that shows us then how closely related WACC is to company value. So say we've got a company then that generates cash flows into the foreseeable future of $1 million a year. Now, the finance manager's key role here then is to think about what the sources of finance are that the company uses, and they can choose then to raise new finance. At the minute then, the weighted average cost of capital of the company is 10%. The finance manager, though, has managed to secure some new debt, which has actually reduced the weighted average cost of capital now down to 8%. If the cash flows in the business then remain the same at $1 million a year, let's have a look then at the impact of this on company value. Well, all we want to do here basically is to discount a cash flow to work out the value of the business. Now, the cash flow here then that we've got goes into the foreseeable future, that 1 million. Foreseeable future in my head means perpetuity. So we need to discount a perpetuity cash flow. And the perpetuity discount factor, if you remember, is 1 over R, where R is your WACC, your cost of capital. So take the cash flow and multiply that then by 1 divided by the cost of capital, which is 10%, 0.1. And we get then that the value of the company, in this case, is $10 million. Now we do the same calculation again, but now we've revised the WACC to 8%. So the cash flow has remained exactly the same, but we're now going to discount that cash flow into perpetuity using the 1 over R again there. And we'll see here then that the value of the company is now 12.5 million. So just by reducing the WACC, by raising some new debt, we've been able to increase the value of the company here by 2.5 million. And, shareholders are going to be really happy about this because they want to see the maximisation of their wealth. So we can see here then how important it is, just by reducing that WACC, how we can really benefit the shareholders and make them richer by maximising the value of the company. We talked about then the returns to shareholders, but let's explore each of these in more detail. So one of the returns then that goes to shareholders is the capital gain. Now, some shareholders here prefer to see increases in the share price of a company. That would give them a gain in their capital. Their capital value here would go up. Now, they might prefer that because they might pay, for example, here a lower rate of tax on capital gains. Remember, this is not a tax paper, so we won't need to get too involved in this, but just an awareness of that point. They might also then have sufficient kind of income then from other sources. They might have a lot of cash resources, so actually they don't need any income from dividends. They'd rather just hold on to the shares and watch their value increase. Other shareholders, on the other hand, might prefer a nice steady stream of dividends. They prefer then the certainty of those cash dividends paid out regularly. From their point of view then, they might be paying a lower rate of tax on those dividends. Again, this is, a very personal decision for each shareholder. They might also prefer the liquidity that comes from dividends. They might not have any other sources of income. They might have bills to pay here. Maybe they're retired. Maybe they're out of work at the minute and they might be, highly reliant on these dividends for their income. Something that is very closely then related to the dividends that are paid to shareholders is the earnings retention of a business. Some companies then prefer to retain a very high level of their profits back in the business. Now, some of the reasons then for doing this is that they are very cheap and easy to hold on to. There's no real restrictions then on what you can do with them. Often when investors perhaps lend you money in the form of debt, there might be restrictions on what you can spend it on. If you've got a grant from the government, you might be restricted on spending it on energy saving measures there. There's also really no ongoing service costs here. There's no interest on the debt to pay. There's no dividends to pay to shareholders. Other reasons might include, the company is maybe a new company, maybe it's in the growth stage there and it doesn't, have a lot of cash, or it finds it very hard to raise cash here. But we'll need to then balance the cash needs of the business to those shareholders then that prefer to receive regular cash disbursements there through dividends. One model then that hopefully you've seen before is the Gordon's growth model. And this really then links or highlights the link then between the earnings that are retained in the business and the future growth in dividends. So let's take a look then at the model. So the formula then uses earnings retention and reinvestment levels there. And it's actually given in the exam as the Gordon's growth approximation. So this is the formula then that you'll see. So G equals B RE. Remember here, the mathematical notation is key. Okay, when we're using a bit of algebra, and don't let that word then put you off, B times RE, we don't need to write, the multiplication symbol in there, but it's, it's almost kind of hidden in there. So watch out for it. As with, I think, all formulas then in the exam, in AFM, you will not be told what the different components mean. So G here then is the annual rate of growth in dividends. And what this formula then basically says is if you increase the proportion of earnings that you retain and you reinvest for growth, well, as long as you're achieving a high return on those reinvested earnings, then you should hopefully see your dividends then grow. Okay, so let's look at a specific example here to help us better understand Gordon's growth rate. So how do dividends grow? So in order then for a company to be able to pay more dividends, it's going to need to generate more profits. And ways then that companies can increase their profits and to grow their businesses are to buy new assets. And an example of that could be for a manufacturing business here, expanding their factory. Now, factories don't come for free. Expanding a factory will require lots of cash. And businesses then will generally retain their profits and reinvest that profits to buy that factory. So what return then will those new assets earn? Well, the company's return on investment, is given as the dividend growth equal to the earnings retained times by the expected return on the investment. So if we think about the example here of the factory, and how that then drives dividend growth, the earnings that we retain are the money then that we've kept back here to expand the factory. And the return then on those assets, on that new factory then, the return on the reinvestment there will be multiplied then by the earnings retained and help us then calculate our dividend growth.